Hello and welcome to the Mutual Fund Show. My name is Niraj and I'll cut straight to the chase today because there are a bunch of things that have been discussed with our two guests on the show, Vijay Mantri and Tarun Birani. Both of them need no introduction. They've been on the show a number of times and are well known in the financial circles any which ways. Gentlemen, both of you, thanks so much for joining in. The first topic that I want to pick up today, and I'm in a bit of a hurry simply because there's just so much to talk about. The first topic that I want to pick up today is the Franklin Templeton saga, right? Multiple opinions about how this should have ended and whether it's right or wrong. I'm not getting into that debate. What I'm trying to get into is what should somebody who's a unit holder of any of those impacted schemes now do, can look forward to. Vijay, let's start off with you.
So, as you rightly mentioned, Niraj, the biggest concern and number one priority for investor in this given situation should be what is the best course of action to get our money back. Not only getting our money back, but how does one get our money faster and how to get money back without any serious impact on the fund which somebody is invested. So in this kind of given situation, I would recommend investor to vote for yes, because if they vote for yes, then there's definitely a very, very high probability that scheme securities would be disposed of in the market in very orderly fashion, and the value of the money would be realized fully. One proof of that is that since the winding down of the scheme on 23rd, 24th April 2020, when the AUM was close to 28,000 crore, since then till today, total amount which has been collected by Franklin Templeton from various schemes, securities which got matured is close to 14,000 crore. They gave around 40% number that they will collect around 40% till this date, but actually they have collected almost 50% of the money. So there's enough proof that securities are decent, because in last 8-9 months we have very interesting and very challenging environment as far as fixed income market is concerned, but most of their securities has realized value and the money is lying in form of cash. And there was some borrowing which has been reduced significantly, and most of the scheme, 4 schemes are running at zero debt, and 2 schemes have today is very low borrowing. So if the investor want their money back and the money back faster, I think saying yes, in my opinion, would be a right thing for investor to get their money back.
Tarun, do you second this, and do you have any other thoughts on this?
So I completely agree to what Vijay has said. In complete spirit, I would say whatever Vijay has said, the investor or unit holder should go for that only. The yes option is the best option available for investors, because to make sure all the securities are sold in a timely manner and no serious threat to the value of the securities is done. Because we, in case if there is a winding up kind of situation happens, you will see a lot of redemption pressure comes in, and due to that, serious impact on the value of the securities will be impacted. So my again strong suggestion is to opt for the yes thing only. Yes.
Tarun, what happens if the fund house does not get the consent from the majority of the unit holders in the case?
So trust me, this is something a situation which we have not seen in the Indian market, and this is for the first time we are seeing a scenario like this. So we will have to see after that how in that situation it looks like the winding up will happen, and the fund house has to honor based on the redemption coming in. So we will have to see how situation pans out at that point of time. But we have not seen a situation like this before. So let's see what all other legal options comes in after that.
Vijay, what about the individual schemes? Because when I was going through, it does seem like that I've noted it down that the Franklin India short-term income plan and the India Income Opportunities plan don't necessarily have the cash that in its entirety, and therefore, should the unit holders of those two schemes will they have to wait for a lot longer than maybe the unit holders for some of the other schemes to get whatever money they do? Anyways, what's the process after that also? Do apprisers of that too? What happens once the investor says yes?
If the investor say yes, then there's no problem, because the scheme will get wind down very faster, because if there's no fire sale, then the securities will get sold in the market in very efficient way. because we have seen many of these securities which was quoting at obscene yield level in the month of March, April. Now the same securities are quoting at much lesser valuation in the primary market. So there's a NAV appreciation to that effect in the market. And many issuers which you see in the portfolio of Franklin Templeton are borrowing money at the much lower rate. So if there's no fire sale, there's no challenge. But suppose there is no, and if there's a no, then there's a redemption. And if there's a redemption, then there's a very high possibility that the Franklin Templeton may be resort to sell these securities in the market. And perhaps, given the volume of the securities they have, it is close to 80,000 crore. There will be definitely some NAV impact if the answer is no. Now, coming back to the specific question of Franklin India Short-Term Income Fund and Franklin India Income Opportunities Fund, where they have, as on 30th November, approximately 1,800 crore was a borrowing, which I believe has come down to 250 crore as on 15 December. So these securities on the normal course of business will take 3 to 4 years to wind down. But if there's no pressure of redemption, then what will happen that these issuer who has issued these securities perhaps get opportunity to borrow at lower rate from other people, and perhaps they prepay them. Or also there's a huge opportunity in the market where these securities would be offloaded, in my opinion, at bare minimum at the prices which they're carrying in the portfolio, in some cases perhaps on the premium. So in my opinion, investor doesn't need to wait for 3 to 4 years. The market condition has improved quite substantially than what was in the month of April and March. So in my opinion, in some of this scheme, you will get in next 3 to 6 months, around 60 to 70% of the money will come back to you. In rest of the scheme, I do not think you are going to wait for more than 1 year plus to get majority of your money. So this is my take on the current situation.
Just a follow-up, Vijay. The projected dates that are given, they are far out, right? You just think that they are the safety standards laid out by Franklin so that people kind of give them the leeway?
So the schedule which they have given is actually on the basis of when these securities are getting mature. So it is the maturity date they have given in every scheme, and if there's a no pre-sale of these securities in the market, then as and when these securities mature, the money will be available to unit holder at regular frequency. But my sense is that these securities in the normal course of business will be sold very fast, because we are living in a very different market than it was in the month of January, February, March. Today, the liquidity is much more comfortable. I take a couple of illustrations. For instance, Vedanta and Shriram, which was part of the portfolio, were quoting at very high prices in the month of, very high yield in the month of March, April. Today, these securities are at much lower valuation. So the fund house has given scheme-wise maturity and when these various securities are going to mature. But looking at the market condition, if there's a no fire sale, then I don't see beyond 12 to 18-month period that security will not get liquidated. In my opinion, these securities will get liquidated, and the customer would get in most of the scheme anything about 60 to 80% in 1 year time, and most of the money perhaps in 18 months to time they will get most of the money back.
Actually, Tarun, that was going to be my question. In each of these schemes or otherwise at large, what's the quantum of money that you reckon will come in? Do you reckon close to the full amount, or would there be large haircuts eventually?
So, Niraj, I have not done individual study of each of security, but my what Vijay also mentioned, there is a huge change in the market since March, and as we speak today, the liquidity situation is definitely way better, and that gives a lot of confidence that we would be much better compared to what we envisaged in the month of the March. So again, my guess is we should be getting a maximum amount out of these securities. Yes.
Okay, Vijay, just one last question on this. Have you figured out if indeed it's full amount or close to full amount, near 100%, or would there be some haircuts and large ones at that people may have to take, irrespective of course? Let's assume everybody does do a vote, a yes, but post that.
I don't think that there'll be don't think there's a possibility of any haircut because the securities which are maturing, many of these companies, the security got matured in last 8-9 months, and almost everybody has paid on time, and many companies had paid before date. So there has been prepayment in the securities as well, because these securities was carrying higher coupon rate. As liquidity improved in the market, the same issuer has borrowed the money at the lower rate in the market and bought the securities back from Franklin Templeton. So I do not see very until unless we have a COVID kind of situation again, where there's a complete lockdown and there's a squeeze on liquidity, I do not see any possibility that the customer will not get money. I think investor will get their money back full with interest.
Okay. Gentlemen, before we move on, is there any other point that we are missing in this Franklin discussion? Either of you feel free to answer.
No, Niraj, I want to make one point that whole rationale of investing into credit funds, high risk credit funds. Even I continue to believe that for an investor, debt as a product is meant to protect the capital. And from a financial planning point of view, I strongly recommend not to venture into high credit risk funds, because in order to earn that 2% extra returns, we end up getting our principal at stake. So to play a risk, I think equity is the best asset class one should look at. But getting into such strategies, and there are a lot of bonds, there are a lot of PTCs, a lot of structures which keep coming in the market, enticing investor to get that extra 2-3%. But my strong suggestion to investor is that look at debt for safety and protection, and there is no point in getting into a strategy like this. And maybe one can look at equity meaningfully to earn that kind of extra returns. Yes.
Okay. Vijay, sorry, you want to differ or should we move on?
No, I think it is fine. I think everybody is wise after they went. My suggestion currently is just look at how do you realize the money, and the best course of action to just say yes, and in the course of time you're going to get the money back. There is around 9,000 crore cash on the schemes in Templeton. The moment you say yes, then subject to court decision, you start getting money back immediately. So your worst days as far as Franklin Templeton scheme from a realization perspective is going to get over very soon.
Actually, just a quick follow-up, Vijay. Sorry, before we wrap up, I know we extend this a bit, but Vijay, just very quickly, what if somebody doesn't vote? Will that be counted as a no-show? I mean, does Franklin need a minimum, and therefore is it imperative that people should go out and vote?
No, actually, it is like a normal voting anywhere. When you go for election of any election or anywhere you go, if you look at anywhere. So it is the total number of people who are turning for the vote, out of which how many say yes and how many say no. So decision will be taken on 50% plus. So if an investor say yes and the majority say no, that doesn't mean the investor can't put for action. Or if the investor say no and the majority say yes, that doesn't mean that investor will not get the money back. So ultimately, whatever decision 50% plus voters has on that day voted and took a call will be applicable to everyone. And voting is electronic, so it can be done, in my opinion, very easily. And the votes will be given in the sealed envelope to the Supreme Court, and then the court will give the verdict that what has been the final outcome of the voting is.
Got it. Okay. Thanks for that, Vijay and Tarun. This is, as I said, front and center, and therefore very, very important to talk about. But beyond this, there are a few others which a lot of queries have come for, and therefore it's important to get your view. Okay, so UTI Small Cap Fund, that NFO I think is on right now. A bunch of small cap schemes have done well. Tarun, I want to get your thoughts here on UTI Small Cap. Should somebody apply, or are there better options available?
So Niraj, my quick take on any NFO would be take NFO if it is unique, it is coming from a parentage which has a long-term track record. So there are a lot of good small cap funds already are available. So I don't think there is a strong rationale to pick up something which is new in the new in the market. But just to give you a quick background of this category, small cap, I feel if the Sensex is trading at a 45,000 level, the small cap stocks, and there are a lot of small cap stocks are available at a 28,000 level. And let me tell you why is it so, because 2018 and 19 had been very bad for this category as such, because post that SEBI diktat in 2018, a lot of small cap, lot of mutual fund schemes had to rebalance their portfolio and sell small and mid cap and buy large cap. Due to that, we have seen a lot of pressure in this category. But post COVID, I think that is one, and due to revival in economy, whatever we can talk about the vaccine thing, there is a lot of positivity around this sector. So I feel small cap need to be part of the portfolio, at least for the risk oriented investor, at 10-15% of the portfolio in this category. If you can hold it for 5 to 7 years, this is a great category, and I see a strong performance for this category.
But not UTI. But not UTI.
And UTI, one point I want to make, their mid cap category has actually done very well in last 1.5 years, and their sector selections have been very good. So again, UTI could be considered, but maybe I would like to take it after 6-9 months, 1 year, once I see some performance coming in.
Any thoughts on the Aditya Birla Sun Life ESG fund, Tarun?
So ESG again is like a fancy word across the globe. Everybody is getting into this space, and there is a lot of rush in the market. So again, I would go for somebody who is already there. But I want to point out one important thing on ESG is a lot of ESG funds globally are taking most of the technology stocks, which are very easy to comply in the environmental norms and everything. So this is again one of the concentrated risk which we are building in this category. So one need to be aware of this part. Because of the ESG thing, there is a lot of mis-selling which may also happen in the market. So I think a normal large cap or a diversified fund is also doing that job. Don't take a ESG fund just for the sake of taking. Yes.
Okay. Vijay, from the Kotak house, there is an offering. What are your thoughts on the Kotak REITs?
Very, very interesting proposition, in my opinion. And I give you 2-3 reasons why it is very interesting. First of all, this Kotak International REITs fund is actually not a new fund. It is feeding into existing fund with close to 10-year track record. The underlying assets are around 48% in Singapore, 33% in Australia, then New Zealand and Hong Kong. The mix of asset is also very good. You have a data center, you have a residential complexes, you have logistic, and you have commercial, so combination of all four. In rupee term, in last 10 years, the fund has delivered close to 16% CAGR over a decade period. If you look at the fund in the current environment, it has a 4.5% yield in the dollar term. Then one could look at potential currency depreciation, which may or may not happen, which could be around 2 to 3%. And then one could look at 2 to 3% capital gain. So if you are looking at the fixed income return in the current market, then this comes as one of the very good alternatives compared to what we have in the fixed income market in India, where Reliance has borrowed CPs 3%, liquid funds are delivering 3%, ultra short term is 4.5%. In my opinion, this fund with the instant liquidity can offer you anything between 6 to 8% on a conservative basis to the investor, and also give very good exposure to real estate sector without compromising on the liquidity part of it. So Kotak International REITs Fund is a very interesting concept, though there are existing REITs available in India in form of Embassy and Mindspace. The challenge with these REITs are that when they declare dividend, which they have to declare of whatever earning they have, 90% of that rent they have to give to the investor, that money become taxable in the hand of investor at marginal rate of tax. But if the same REIT is coming through mutual fund route, where the mutual fund investing in these underlying REITs, then the rental which get distributed by these REITs to the funds doesn't get taxed at the fund level. So NAV to that extent goes up. and is only get taxed when the investor take money out from the fund. So from a tax efficiency perspective also, it is a very good option. So it is an interesting option investors should examine. And in my opinion, given the current market condition, a decent part of the customer money can be invested in Kotak International REIT Fund.
Okay, thanks for that, Vijay. Well, interestingly, Rinsi Ansalam feels that there are some evasive answers by our guest on the topics. Well, Rinsi, if you're referring to the Franklin Templeton answers, then both our guests believe that you should unequivocally go out and vote for a yes. If it's for the NFOs, then I think we've gotten 3 answers right now on the 3 NFOs or the 3 offerings. Let's try and see if we get an evasive answer of the others. But if not, we'll just try and, I mean, if they do, then I'll certainly cross question them. But Tarun, let me ask you and not give an evasive answer on the actual Axis Special Situation Fund. What is your verdict here? Should people go out and subscribe? Yes or a no?
So I think yes and no is a very relative thing. Trust me, I don't want to get in that. I want investor to see whether this as a category is available in their portfolio or not. But as a product, it's a unique product that I felt that 30% of the portfolio is going outside India. So this gives you a global diversification. Again, with the access tie-up with the global fund management of Schroders, it again gives you a very good global exposure, and they have a good expertise managing this special situation. So one can consider that. But my only disconnect with all these different contra, special situation, and all these themes are they end up buying something. They always position it like buying very cheap kind of thing, which I think end of the day all the funds are trying to do. So why do we keep testing all these new things? So maybe one can see the performance for some point of time and then look at them rather than buying now.
No, then, right? You are saying don't invest right now. Wait
yes,
for
I will avoid it. I will avoid it.
Got it. Okay. So, well, the Axis Special Situation Fund, and Tarun, I think, largely is of the opinion that NFOs can be avoided, and he's believing that even this one may not necessarily be the best option. Okay. Just a quick follow-up, Vijay. On a bunch of these options available, I'm throwing this out of the dark at you, but a bunch of these options available which either do a fund of fund strategy on a global fund or have the option of investing into global stocks. Now, out of the plethora of options available, which to your mind or to your house's mind is amongst the better ones to invest in? I think there is an Invesco product also which is on right now, which gives you that option. There's this access option too. And there are some already existing options. Which one to your mind is amongst the better ones? And that, by the way, by saying that, Vijay, let me qualify. It doesn't mean that you are saying that the others are bad. You're just choosing one which you like, which doesn't mean that the others are bad.
So the investor have choice of invest directly in international market through liberalized remittance scheme, and investor also have a choice to participate through a domestic mutual fund which feed into international fund. And it is the difference is identical to buying domestic mutual fund versus buying domestic equities. So there are certain people who feel very comfortable buying direct stocks. They have a sense of ownership when the stocks come into their portfolio. They get regular dividend, they get company's annual report. So huge sense of engagement and ownership. So people get a different feel when they invest in direct stock. When they invest through a mutual fund compared to direct stock, it looks a little passive. But if you are venturing into international investing, then you do not know what the underlying companies could be. So I give a simple illustration. In the month of March, when the lockdown started, Zoom technology went up 50% in no time. But people figured out later on the Zoom technology was not the same company which was the business of video conferencing. Later on, they figured out the company was different because the code was very different. And that company which went up 50% was not in operation for 5-6 years. So you end up making these kind of risks when you look at investing. But they are very, very interesting concept coming in Indian market. Why it is becoming very interesting to look at these options, because what we have seen that the consumers are in Indian market, but the company profiting out of these consumers are not in Indian market. They operate out of some other market. So you're spending money, but the profit going somewhere else. So through these international opportunities, you can participate in that kind of opportunity as well.
But which one, Vijay? So let's establish it, that it is there, it is interesting to do, and let's assume that the person doesn't want to invest the money himself or herself. Which fund option is a good option?
So currently we have around 2 years back we have recommended US fund, but today we are not recommending US fund because US market has run too much, and it has shown 20% CAGR over a 10-year period, which in our opinion one of the best return US has delivered. So we are looking at something outside US, and this Invesco Global Consumer Fund is one option which have a very low correlation with Nasdaq or S&P 500 or whatever existing options available in Indian market through mutual fund route. So this Invesco Consumer Global Consumer Fund look at where consumers are spending their time, and consequently where they are spending their money, and they are tracking these trend, and then the company which are going to benefit out of that. And this fund have a 26-year track record, and it is a real outstanding track record. So I would look at Invesco Consumer Global Consumer Trend Fund as a one option one investor can look at investing.
Okay. We are slightly short of time. I'm going to avoid the flexi cap conversation because we also, viewers, remember, if you look at some of the previous shows, we've kind of discussed the multi-cap versus flexi cap options. So maybe you could look at some of those videos. We have time because there are so many questions around SBI. We'll probably take that up and then wrap the show. Tarun, I'll come to you first. Navneet Munot, moving on from SBI, could that have an impact on the SBI schemes? Should an investor in any of the SBI schemes be worried that the CIO of the fund house is moving to another house?
So not really, because Niraj, I feel that SBI has a strong investment team. Their equity team as well as the debt team is a pretty stable one with a long-term track record. And what I understand is they have now co-CIOs have been taken on board. The existing equity plus the debt CIO will be co-managing as a CIO. So this again gives a lot of confidence. It's an old team. So I really don't see any concern from that point of view. That yes, a key personal leaving definitely puts a question. But what I have seen is over a period of time, they have put in a lot of strong processes in place, and they have a very strong team which is handling the same. So I'll not look into that much.
Vijay, your thoughts differ?
Yeah, see, it is very difficult to replace a person underneath the skill and capabilities. But one need to keep in mind that the way SBI mutual fund is running over the past decade or so, they are running very professionally. The compensations and the work environment are identical to what is available in the private sector. In addition to, they have a fantastic brand, and they have a huge network of SBI, and they have a corporate relationship with almost every Indian investor. So they are managing more than 4 lakh crore of AUM in the mutual fund side alone. Then they have ETF and all kind of thing. So their ability to attract good talent, is without question. Second, the existing team. Navneet was not managing any fund per se directly. The existing head of fixed income and head of equity have been managing the fixed income and equity portfolio respectively. So as on date, as far as SBI mutual fund schemes are concerned, there are no red flags. Let's see how situation emerges over a period of time. Perhaps then one could take a call whether the performance, suppose the performance deteriorate, is it deteriorating because of leadership change or deteriorating because it is a market cycle? So as on date, absolutely no red flag on SBI schemes.
Gentlemen, thank you so much, both of you, for taking the time out and speaking to us today on the Mutual Fund Show. Really appreciate your time and much appreciate your advice.
Thank you.
And viewers, amongst other things, some of the fund recommendations you would have noted. Don't get too worried if you're an SBI shareholder, SBI mutual fund investor. So that's the other bit. And on the Franklin Templeton issue, both our experts believe that you should vote a yes for the winding up of the schemes. I hope all of this helped. Thanks so much for tuning in to the Mutual Fund Show.